Okay, let's unpack this.
Let's do it.
Today's deep dive pulls from one of the most concentrated weeks of market-moving decisions we've seen in years.
It really was. We're talking about the intersection of tech, high-stakes finance, major policy shifts, and, well, some very volatile global politics, all of it colliding in just the first week of January 2026.
And our source material is a fascinating stack. Articles on multi-billion-dollar VC raises, nuclear power grabs for AI, and these policy levers that can instantly drop mortgage rates.
Right, and even how the ultra-wealthy are structuring their fortunes to avoid risk.
So our mission for you is not just to summarize these facts, but to synthesize them. We want you to walk away seeing the hidden connections, the links between, say, the AI energy crisis and the future of your pharmacy.
Exactly. It's about identifying the signal in all this noise. We're looking at a moment where technology, capital, and government influence are all making these huge, decade-long bets.
You really need to understand these concentrated points of power to be well-informed. We've got major new strategies from Silicon Valley titans, a revolution in weight loss drugs, and a look at how executives protect their fortunes. So here's where it gets really interesting.
Let's start with maybe the largest emerging challenge in the world: finding enough power for AI.
It's the central tension of the AI boom, isn't it?
Yeah.
The models get bigger, the demands get hungrier, and suddenly tech companies aren't just software firms anymore.
No, they're becoming massive energy infrastructure developers. I mean, look at Meta. They're leading the charge to secure power for this new Prometheus supercluster system they're building in Ohio.
And the scale is it's breathtaking. They've signed agreements with major nuclear power providers, Vistra, TerraPower, Oklo.
And the goal?
The goal is to add 6.6 gigawatts of power by 2035. To put that in perspective for you, 6.6 gigawatts is more than the total energy demand of the entire state of New Hampshire.
Right, so you're not just building a data center. You're building a new utility company just to power one company's AI ambition.
And it's not an isolated incident. We're seeing other giants move in parallel.
Oh, absolutely. OpenAI, backed by SoftBank, just announced a $1 billion investment into SB Energy
For that data center in Texas, right?
for a 1.2 gigawatt site in Milan County, Texas.
Yeah.
It's part of that, staggering $500 billion Stargate commitment.
Yeah.
It's crystal clear that the future of AI is tied directly to nuclear and renewable energy.
But what's really insightful here is the financial integration. The connection is so tight. Oklo, one of Meta's new nuclear partners, well, it's backed by OpenAI CEO Sam Altman.
He owns a 4.3% stake. It's a perfect illustration of this interlocking ownership between the people building the AI and the people building the reactors to run it.
It creates this high-speed, closed loop of investment. But as AI capacity explodes, so do the immediate regulatory and ethical crises.
That's the tightrope. The very same week we see billions poured into infrastructure, we see these high-stakes demands for digital safety.
Which brings us to Grok and X. 3 Democratic senators, Wyden, Markey, and Lujan, called on Apple and Google to do something pretty unprecedented.
Yeah, to suspend Elon Musk's Grok and X apps from their app stores. Full stop.
And their argument focuses on the app's reported ability to let users just easily create and share non-consensual explicit images.
Which includes, and we have to be clear here, sexualized depictions of minors' child sexual abuse material and images that denigrate people based on race or ethnicity.
The examples cited they're severe. A report noted a descendant of Holocaust survivors was, quote, digitally stripped by Grok after users prompted it to generate an image of her in a bikini outside Auschwitz.
It's horrifying. And the senators basically said that if the app stores don't act, it fundamentally undermines your claims that your app stores offer a safer user experience.
So this is that critical tension, the speed of innovation versus basic public safety. XAI, Grok's developer, just closed a massive funding round.
$20 billion. With heavyweights like NVIDIA and Fidelity, the money and the momentum are just enormous.
And yet, they're facing potential deplatforming from the 2 largest distribution systems in the world because of these safety failures. It raises a huge question, doesn't it?
It does. When does an AI's capability, no matter how well funded, become a regulatory liability if the ethical guardrails fail at such a basic human level?
A collision of profit and societal risk.
Okay, let's shift gears completely. We've been talking about the infrastructure for technology. Let's look at the infrastructure for human health and the changing retail landscape.
The oral GLP-1 revolution is here. This is a game changer for accessibility and obesity treatment. Novo Nordisk has started rolling out the pill version of its blockbuster injectable Wegovy in the U.S.
And this is where retail strategy meets health delivery. Amazon Pharmacy is jumping into this market aggressively.
Very aggressively. They're offering the drug with one of the lowest cash prices out there. It starts at $149 a month for cash payers.
And for eligible customers with insurance, it's often as low as 25 bucks. Right. And health experts emphasize that having an oral option is critical. It expands access to millions of people who, might be afraid of needles or just view injections as too serious.
And Amazon is cementing this by putting the pill in prescription vending kiosks in some One Medical clinics.
It seamlessly integrates their digital pharmacy with their physical healthcare footprint.
But while consumers are finding these legitimate savings, we have to talk about the dark side of drug cost reduction. These so-called alternative funding programs, or AFPs.
This is a really complex and, frankly, dangerous situation. Patient advocacy groups like the HIV plus Hepatitis Policy Institute are in federal court trying to stop them.
So what is the model? How does it work?
It's basically a workaround for U.S. employers to cut costs on high-priced specialty drugs, like, say, Gilead HIV medications. The AFPs buy these drugs overseas from places like Turkey.
And that's where the problem is.
That's the huge problem. The FDA and DHS have warned this practice is illegal and exposes patients to unsafe supply chains. Turkey specifically is a known hub for counterfeit drugs.
So advocates argue this forces patients to trade the safety and certainty of the regulated U.S. supply chain just so their employer can save a buck.
Precisely. It's an ethical mess where employers are basically offshoring pharmaceutical risk to help their bottom line.
Speaking of structures under pressure, let's look at the other end of retail. Luxury.
Saks Global, which owns Neiman Marcus and Bergdorf Goodman, is hanging by a thread. They are struggling to secure up to $1 billion in what's called debtor-in-possession financing.
And DIP financing, that's the money that keeps a company running while it tries to reorganize in bankruptcy, right?
It's the lifeblood. And the fact they're struggling to get it is alarming. It means lenders don't believe they can successfully reorganize.
So why are investors so skeptical right now?
The causes are deep. There's still debt from the 2024 Neiman Marcus acquisition, they have inventory gaps, and the whole luxury market is slowing down.
So if they fail to get this loan,
then Chapter 7 liquidation becomes much more likely. That would be the total end of this 159-year-old department store lineage.
it just shows how quickly fortunes can change. Okay, let's pivot to the macro picture. The big policy decisions that move markets in minutes. We got the December 2025 jobs report this week.
And the results are definitely mixed, leading to some conflicting takes.
The top line number, non-farm payrolls, rose by 50,000. That missed the estimate of 73,000.
But the unemployment rate actually fell to 4.4%, a little better than forecast. And the broader measure, which includes people who've given up looking for work, that dropped too.
But the real story comes when you zoom out. Economist Heather Long called 2025 a hiring recession.
And the numbers back that up. Payroll gains averaged just 49,000 a month for the whole year. That is a dramatic drop from the 168,000 we saw in 2024. The labor market is tightening, and it's tightening fast.
And this report came right after a political flap. President Trump seemed to reveal some of the private sector data on Truth Social the night before the official release.
Which is an apparent violation of federal policy. You're not supposed to comment until 30 minutes after the official release.
It just underscores how fast political commentary can shape market perception. Speaking of immediate policy intervention via social media.
Housing!
Yes. The president ordered Fannie Mae and Freddie Mac to buy $200 billion in mortgage bonds, also via a social media post.
With the stated goal of instantly driving down mortgage rates.
And the market responded instantly. The rate on a 30-year fixed mortgage dropped 22 basis points to 5.99%.
Which is the lowest level in nearly 3 years.
That drop is tangible. If the rate settles around 5.9%, it would cut the monthly payment on a median-priced home around $425,000 by $118 a month. That's real savings.
But, and there's always a but, experts are quick to point out that overall affordability is still a huge hurdle.
Right. Why? Because home prices are still nearly 50% higher than they were before the pandemic. You might save on the interest, but the asset itself is still astronomically expensive.
And we still have this massive uncertainty hanging over trade policy. The Supreme Court didn't issue a ruling on the legality of those sweeping tariffs levied under the International Emergency Economic Powers Act, or IEEPA, and the stakes here are enormous. If the administration loses, the ruling will determine if the U.S. government has to reimburse importers for all the duties they've already paid.
We're talking about tariffs that brought in $195 billion in fiscal 2025 alone. That's a staggering amount of money.
But the White House seems unfazed. The National Economic Council director said they have contingency plans using other legal authorities, like the 1962 Trade Act.
So the message is clear.
Yeah.
They're determined to keep the tariffs themselves, regardless of the IEPA ruling. It's a battle over the method, not the policy.
Exactly. Okay, let's move to high finance and the tactics the ultra-rich use to manage all this risk. We're seeing a spike in these specialized instruments called exchange funds.
These are for wealthy executives and founders, right? People with a ton of their net worth tied up in a single stock.
Especially in tech and AI. The problem they face is diversifying without triggering a massive capital gains tax bill immediately.
Okay, so let's drill down. How do these funds actually work? How do they defer the tax?
It's pretty ingenious. An investor contributes their highly appreciated shares to the fund. The fund then pools those shares from lots of different executives.
Creating one big diversified pool of assets.
Right. Then, after a lockup period, usually 7 years, the investor redeems their interest. But, and this is the crucial part, they don't get their original stock back. They get a diversified basket of stocks from the whole fund.
So it's not a sale, which would trigger the tax. It's an exchange. Concentrated assets for diversified assets.
Exactly. Deferring the capital gains until that new diversified basket is eventually sold. It's a powerful tool.
But what's the challenge for wealth strategists trying to get clients to use them?
It's the psychology of it all. These executives remember that one stock as the blessing that made their fortune. They extrapolate that success forward, so it's incredibly hard to convince them to hedge their bets.
Shifting from wealth protection to wealth creation, we saw one of the biggest moves in VC this week. Andreessen Horowitz, A6 Tencent, raised a whopping $15 billion for new funds.
And the allocation is what's fascinating. It reflects a very clear strategic, almost geopolitical focus.
How so?
While the bulk goes to growth and infrastructure, $1.2 billion is specifically for their American Dynamism Fund.
And that's targeting sectors vital to national power, aerospace, defense, companies like Anduril and SpaceX.
Absolutely. Co-founder Ben Horowitz was explicit. He said America has to win technologically or risk losing on every other front, economic, military, you name it. This is VC funding as strategic national policy.
Now, in stark contrast to those huge, heavy bets, let's look at a very different success story. The asset-light model of IMAX.
Their stock soared over 44% in 2025, a record $1.28 billion global box office.
Meanwhile, traditional chains like AMC and Cinemark saw their shares crater.
And the reason is that Hollywood is all about blockbusters now, and consumers are prioritizing that premium large format, or PLF, experience.
People are willing to pay more for it.
A lot more. PLF tickets averaged $17.65 last year versus $13.29 for general admission. And crucially, IMAX is asset-light. They partner with chains to install equipment and just take a share of the receipts.
So they avoid the crippling debt and rent that's sinking the traditional operators.
Exactly. It's a much more sustainable financial structure.
Okay, finally, we have to look at a series of rapidly escalating geopolitical flashpoints. First, Venezuela. Following the capture of President Nicolas Maduro, President Trump met with oil execs.
Big ones. Exxon, Chevron, ConocoPhillips. The plan they outlined is massive. A $100 billion investment to rebuild Venezuela's energy sector with U.S. protection.
And the policy mechanism is key. The U.S. will leverage the oil sales to drive changes, and the revenue from those sales has to be used to buy U.S.-made products.
Like agricultural goods and medicine, it's energy and foreign aid tied directly to U.S. industrial benefit.
At the same time, there's rising tension with Mexico. President Trump suggested the military will start hitting drug cartels on land in Mexico.
Which flies directly in the face of Mexican President Claudia Sheinbaum's previous stance on sovereignty.
And the rhetoric over Greenland escalated even further this week. The president said his administration will take action on acquiring it, whether they like it or not, citing national security.
And China is watching this very closely. They see this as a direct threat to their commercial interests there, especially rare earth minerals and their Polar Silk Road shipping routes.
Lastly, a significant domestic incident in Minneapolis. New cell phone video was released from that fatal shooting of Renee Nicole Good.
Reportedly taken by the ICE agent involved, Jonathan Ross. The video shows her SUV driving toward him.
And you have two completely opposing narratives forming around this video.
Exactly. The Trump administration claims it's clear evidence of self-defense, that she weaponized her vehicle. But Minnesota officials dispute that, suggesting she was just swerving to get around agents who were blocking the road.
So if we pull all this together, what's fascinating is the sheer scale of the concentrated capital and policy we've covered in just 7 days.
It's huge. $15 billion from A16s, a $200 billion mandate for mortgage bonds, $100 billion planned for Venezuela. And that's before the AI energy demand.
It suggests we're at a pivotal moment. The decisions being made aren't small or incremental. They are huge, centralized bets on the future of the economy and global influence.
And we've seen how fast the market responds, whether it's to jobs data or a social media post about mortgage rates. We've seen the battle for digital safety clash directly with corporate profit and innovation. It all comes down to risk, reward, and the structures designed to manage them.
Which raises an important question for you to think about. If executives are using these specialized exchange funds to hedge their own single-stock wealth, to protect themselves from a dumpster fire with a massive tax-deferred safety net, how quickly will mainstream investment vehicles adapt to offer similar tools for the average investor who's caught in this same world of increasingly rapid high-stakes volatility?
That's an excellent thought to leave things on for today.
Until next time.